Hello everyone, welcome back to my channel, The Learning Path. This is Dr. B. Meena, Associate Professor and Research Supervisor from Petition College of Arts and Science, Adayar, Chennai. In this video, I'm going to teach you one of the modern method followed in capital budgeting technique is profitability method, or otherwise known as excess present value method. And as usual way, I already discussed in the previous video, if in case annual cash inflows were not given, we need to make use of this format, how to calculate the annual cash inflows. That is profit before tax and depreciation. From that, we need to deduct the depreciation first of all. If the depreciation amount is not given in the question, we need to work out like that by applying the formula, what is the project cost or investment divided by number of years. That tells you what is the value of the depreciation. So deduct the depreciation from profit before tax and depreciation, then get the answer name is profit before tax and after depreciation. So then the next step is to deduct the taxation. Once you deduct the taxation, then your answer is profit after tax and as well as after depreciation. So the annual cash inflows inclusive of depreciation. That is why we are adding the depreciation and it's the final step. So once you calculate the annual cash inflows, as I already discussed in my previous videos, then we need to work out the profitability index through this format. So as usual, we will substitute the cash inflows of the respective years and the present value of the discounted rate 10%. If it is 15%, it means we will work out the other calculation. That is 100 and instead of 110, we'll write 115. Just check out how you need to work out these values if the values were not given the problem. I already discussed in my previous video when I took a end present value method. So once you multiply the cash inflows with the a discounted 10% value, then you will get to know what is the present value of each and every year. Once you get the present value for all the years, get the total present value and compare with your investment, what is the net present value. And this net present value, and that is once you calculate the total present value, that is more than enough. No need of calculating net present value. That is profitable index method you are going to work on means just take the total present value divided by investment. So total present value divided by investment is the formula to calculate the present value of the index, or otherwise call it as profitability method index. Check out one problem to have more understanding on that. Darshan Limited is considering two alternatives for the purchase of new machine X and Y. So the costing is 4 lakhs. The earnings after tax and before depreciation are expected to be as under. So we have the cash inflows of machine X and machine Y from first year to fifth year. And this is, what is that? After tax, but before depreciation. And the present value, the discount percentage is given is 10%. The value is also given. Determine which machine is better on the basis of profitability index. Now check out this. What is that? In that first column, I just allotted years. And the second column, NPV at 10% values I mentioned for each and every year. Then third column is machine X, fourth column is machine Y. For both the machines, investment cost is how much? 4 lakhs. So I just returned the cash inflows of machine X and machine Y. Then multiply the discount rate 10% with the respective cash inflows of each and every year for both machine X and Y. Like 40,000 into 0.91, I'll get 36,400. 1,20,000 into 0.91, I will get 1,09,200. Likewise, I will work out 1,20,000 into 0.83, 1,60,000 into 0.75, 2,40,000 into 0.68, 1,60,000 into 0.62. If I multiply the values 10% discount values with the cash inflows, I get to know what is the present value for both machine Y and machine X. Likewise, 1,20,000 into 0.91, 1,60,000 into 0.83, 2 lakhs into 0.75, 1,20,000 into 0.68, 80,000 into 0.62. I'll get all these values. Once I completed calculating present value for both the machines, I will get the summation of the present value of machine X and machine Y, that is call it as total present value. Then compare with my investment 4 lakhs, then I'll come to know what is the value. So profitability index, that is profitability index is what is that? Total present value divided by 4 lakhs, 1.296. I said in the previous slide itself, total present value itself is enough to complete the problem. No need to calculate the NPV and all under profitability index. So total present value divided by investment. Total present value divided by investment. For both the machines I calculated, the values I just calculate 1.296 for X, 1.308 for machine Y. So based on these values, I can conclude myself my machine Y is preferable because of its highest profitability index, that is machine Y index value is 1.308. So on the whole, I want to conclude, if in case the question is asking you to calculate the profitability index method, or like this, determine which method is based on the profitability index, or else we need to calculate under excess present value method, means you just calculate the total present value divided by investment. This is the formula to calculate the profitability method, which is otherwise known as present value index. No need to calculate net present value also. Just stop calculating total present value divided by investment. That tells you the what is the present value index or profitability value index. And you may have this kind of questions. Compare the index values of both the machines and you can conclude like this. So this is all about how to work out the profitability index method. Thanks for watching my video. See you again in next video. Until then, bye bye.